Hey guys, you might have probably heard of the S&P 500 index, but not really known what it is in the reality. So today we're gonna talk about S&P 500 index. There is a rating agency called Standard & Poor's, or S&P, and that rating agency created a list of top 500 largest companies in the United States and called it S&P 500. So in short, S&P 500 index is just a list of top, but not all of them, 500 largest companies in the United States. And the ticker symbol for this index, which is used as a short name for indexes and companies on the stock market, is SPX. And actually the amount of the companies in the index may vary and not be always exactly 500. Sometimes it's 505, sometimes 507, but the exact amount doesn't actually matter because to be included in that list, the company has to meet some certain criteria defined by that rating agency. So at the moment, the top holdings of that S&P 500 index is companies like Apple, Microsoft, Amazon, Google, Tesla, Berkshire Hathaway, which is a company of one of the greatest investors, Warren Buffett, Nvidia, Johnson & Johnson, and so on. And this S&P 500 index is often referred as the benchmark or the market. This is because S&P 500 has a total capitalization of 70 to 80% of the total stock market of the United States. And it's a commonly used benchmark for portfolios in the US and abroad. And beating the market means beating the S&P 500 index performance is the top goal for different hedge funds, private investors, and portfolio analysts. And if we take a look at the history of the S&P 500 price, then we can see that over time is just increasing. And no matter what, if you invest in this index, your portfolio will grow no matter what. You just hold your positions and wait until it grows. S&P 500 index is a capitalization weighted index. It means that the companies have amount in this index which is related to their size. For example, number one holding, which is Apple, will have 6.6% of total weight in this index. Microsoft will have 5.9%, Amazon will have 3.5%, Alphabet, which is Google, there are Class A and Class C, so the Class A will be 2.1%, Class C will be 2%, and so on and so on. It means that the price change of the large companies will affect the index overall more than the price changes in the smaller companies, which is quite fair. So one of the good points to invest in exchange traded funds that are following this index is just because it's constantly growing, because it's the market and the economy is constructed in such a way that it is constantly growing. And another way is that this specific index is very nicely diversified, well, amongst companies. We already know that there are 500 companies, and as well among sectors, because there are 11 sectors total in the economy, and this index holding stocks of each of that sector. So, for example, communication services, which will represent a total amount of 9.6% in the index, will represent such companies as Alphabet or Google, Facebook, Verizon, Comscore Corporation, AT&T, and so on. Consumer discretionary, which represents 11.8% of the total amount of the index, will represent such largest companies as Amazon, Tesla, the Home Depot, Nike, McDonald's, and so on. The consumer staples sector will represent 6.2% of the total amount of the index and will include such companies as Walmart, the Procter & Gamble, the Coca-Cola Company, Costco, Pepsi-Cola, Philip Morris International, Target Corporation, and so on. The energy sector will represent 3.7% of the index and will include such companies as ExxonMobil Corporation, Chevron Corporation, ConocoPhillips, and so on. The financial sector will be 11.5% of the total amount of the index and will include such companies as Berkshire Hathaway, Visa, JP Morgan Chase, Bank of America, MasterCard, Morgan Stanley, and so on. The healthcare sector will represent 11.3% of that index and includes such companies as United Health Group Incorporated, Johnson & Johnson, Pfizer, a lot of biopharma companies here. Industrial sector will represent such companies as United Parcel Service, Union Pacific Corporation, and so on. And it represents a total amount of 8% of the index. The informational technology or IT sector represents 28.1% of the index and includes such companies as Apple, Microsoft, Nvidia, Cisco, Oracle, Adobe, and so on. Basic materials currently represent 2.6% of the index. Real estate represents as well 2.6% of the index, with such companies as Prologis, American Tower Corporation, and so on. And utilities as well represent 2.6%. And keeping that in mind, you might think that you don't want to put some of your investment in sectors like materials or utilities, but this is a secret of diversification, because in the different economical cycles, each of the sectors, they may perform in a different way. And while some of your tech companies may be falling down, the companies from sector like utilities or materials may grow up, and you'll be happy and glad to see that, and not seeing your portfolio going down together with, for example, as with tech sector or consumer cyclical sector, which will go down in a recession or in the late cycle. And now I want to talk about difference between the S&P 500 index and index fund, because index is just a list of companies which is updated sometimes, and some companies are added to that list, some companies are extracted from that, and the list of companies may change. And the thing is, you cannot buy this list of companies. You can just observe it and keep it as a benchmark, as a market. On the other way, the ETFs are the private companies, which gives you the possibility of buying the shares, which will consist of each of that 500 companies if such ETF tracks the S&P 500 index, so that you can be a shareholder of all that companies, buying just a single share from different companies. For example, Vanguard or Spider, there are different companies which make such ETFs, but all of them, for example, that ETFs which track S&P 500 index will be performing the same. The difference between them maybe is just the different companies holding these ETFs, and different commissions are applied if you want to be a shareholder of that specific ETF. But the ETFs may be constructed for different indices, not only S&P 500, which is the index of largest companies. There may be indexes for small cap companies, for middle cap companies, for obligations, for IPOs, and so on and so on. And so investing your money into S&P 500 index exchange traded fund may be a good idea if you want to have your investments growing passively and you don't have to apply much attention to that. For example, here is a hypothetical growth of $10,000 if you invest them, and what will happen to that in a 10-year period. So if you would invest $10,000 in 2012, by now it would grow up to around $40,000 for a 10-year period. So the bottom line is that the S&P 500 index is a measure of large cap stocks that are publicly traded on the US stock market. Over long periods of time, passively holding the index often produces better results than actively trading or picking single stocks. And even Warren Buffett himself admitted that holding just the S&P 500 index, no matter how boring it may seem to you, will be a good strategy in the long term. This is what he said. Long-term results from such policy will be superior to those attained by most investors, whether pension funds, institutions or individuals who employ high fee managers. With that in mind, I hope this video was useful to you and you've got to know what is S&P 500 index, what is the difference between index and the index fund, and how it all works. And well, see you in the next video.